Imagine 3 years ago, I get an email from Bill and Jackie, and I'm just going to read it to you. Here's what it said. Josh, you were referred to us by some of our dear friends. We are a couple approaching our 60s, and recently we had a long-term care experience with Jackie's dad. 5 years ago, Jackie's dad, Ron, was diagnosed with Alzheimer's. He was only 71. About a year in, he suffered a stroke, and Jackie needed to help her mom, who was 6 years older than Ron, take care of him at home. We checked into long-term care facilities a few times, but for the private room, the cheapest we could find for the level of service he needed was $7,700 a month, almost $100,000 a year. We checked into Medicaid, but they had too many assets to qualify. Jackie's mom and dad weren't rich, but they had socked away several $100,000, and we knew that money would only last for a few years if he entered a care facility. So Jackie and her mom became the full-time caregivers. Even though Jackie's mom was in good health, she was still 6 years older than Ron, and so Jackie, my wife, had to help out a lot. After about a year, Jackie had to quit her job to help her mother out full-time. Well, Bill, I'm an engineer, and I traveled for work a lot back then. And to be honest, not having both our incomes put a lot of stress on our family and our two sons over the last several years. There just wasn't enough time to do everything. Finally, we had to put Ron in a facility. The level of care he needed was over $8,500 a month. Within 4.5 years, almost all Jackie's parents' savings were gone. Ron passed away in his sleep about 6 months ago. Now Jackie's mom is penniless at age 81 and lives only on Social Security. As for ourselves, with Jackie quitting her job at a crucial time, she is back to work now, and now we need to supplement her mother's income as well as help our two kids as they go through college. Our retirement plans have been pushed back a few years as well. We're not resentful, and we love them both very much. We just didn't realize their decision would so heavily impact our lives. All that being said, we don't want our two sons to have that experience when we get older and might need care. Of course, we hope it never happens, and we hope we never need care, but we think it's wise to be prepared just in case. We've heard of long-term care insurance, and some people seem to like it, especially the people who sell it, and most everyone else seems to hate it. We've looked into buying it before, but we've always struggled with the idea of paying a bunch of money into a policy and then never using it. That just seems kind of like a waste of money. Our friends who told us about you said you may have some other ideas. Can you help us? Sincerely, Bill and Jackie. After reading the email through twice, I hit the reply button on my computer and simply typed, "Maybe I can help. Come to my office at 10 a.m. on Friday, and together we'll see if there's anything you can do." Friday morning came, and there were actually torrential rains that started around 8 o'clock. This is actually a picture of my office, but pretend it's raining. The highways were moving painfully slow, and I wondered if I would hear from them. But true to their word, about 9:55 a.m., they walked into my lobby, put their umbrella in the corner, and my receptionist called me on my desk phone and said, "Bill and Jackie are here." We spent the next hour and a half taking a deep dive into their finances, their income, their cash flow, their assets, and their debt. We talked about their medical history and what medications they were taking. I didn't want to waste their time or mine, so we covered everything. At the end, we scheduled a meeting for a week later, and I promised I would do some homework and do my best to find something that would fit their main 3 goals. Here were their top 3 goals. They said they wanted at least 5 years of coverage for both, at least $6,000 per month of coverage for each of them, and they wanted the ability to use the money for home health care. I watched them as they fought through the rain that was still coming down as they made their way across the parking lot, and they drove away. The next week rolled around, and again, my receptionist called me on my desk phone and said, "Bill and Jackie are here." They walked into my office, and after shaking hands, we got right down to it. "Bill, you've got a little over $1 million in your 401k. You've done a great job saving. In addition, you have $200,000 in a savings account at your local credit union. Can you tell me what that is for?" "Well, Josh, that's just sort of our rainy day fund," he said. "I think it's making 1%, and I realize that's not much, but if we ever need it, we know it will be there." I replied, "So you're not setting that money aside to buy a motorhome or a lake house or anything?" Bill and Jackie both nodded their heads no and reiterated it wasn't there for any purpose at all. And so I went for it. Here's what I said. "I'm going to suggest something that makes a ton of sense for you, but you're not going to like it right away." Naturally, they both inched towards the front of their seat with a puzzled expression on their face. I started in. "I think you should take half of that money and put it into an asset-based long-term care plan." Jackie shifted uncomfortably in her seat, and Bill slowly said, "What?" I knew that would be their response, so I settled in and said, "Let me walk you through it. You told me you wanted 3 things. 5 years of coverage, at least $6,000 per month of coverage for each of you, and the ability to use the money for home health care. Well, I was able to blow your number 1 request out of the water and to fulfill requests 2 and 3. First off, This plan provides $6,000 per month of coverage, just like you asked. And it gives you the ability to use the money for home health care just like you wanted. You don't have to go into a care facility. If you want a nurse to come to your home, this plan will pay for it, so you don't have to. If you need to go to a facility, you can. The key is you are in control. Now, on to the good stuff. This plan is designed to give you 3 benefits you didn't ask for or even think of, and that's why you're going to end up liking this. The number one reason this plan is so popular is if you die and don't use it, there is a $175,000 tax-free check that will be written out to your sons. What this does for you is it makes sure you don't just waste your money on this. So you put $100,000 into it and you never use it. And guess what? That money almost doubles and goes back to your sons tax-free. I could sense Bill and Jackie starting to warm up, so I continued. Number 2 is something our higher net worth families love. If you get into this 1, 2, 5 years, however many, and you decide you want to change your mind and you don't want this coverage anymore, you can get your money back. What I mean to say is this is liquid. You change your mind, fine, you can get your money back. Now, to be full disclosure, it ends up being about 97 to 99% liquid, depending on when you first start and when you pull it out. But there's a little bit of internal policy expense, but that expense is basically negligible. The reason our higher net worth families like this benefit is because you still get to retain control of the asset. If you want the money back, fine, take it back. But I'm telling you, no one ever does. This plan is too good. At this point, Bill interrupted. What's the third benefit we didn't ask for? I chuckled. Stop rushing me, Bill. Number 3, instead of 5 years of coverage like you asked, I would recommend adding an enhancement rider that costs about $100 a month per person, or $200 a month for the couple. And by adding that rider, we can transform this plan into offering unlimited lifetime coverage for both of you. In other words, if one of you needs care in the home or in the facility for 2 years, it will pay. If you need it for 7 years, it will keep on paying. If you need it for 15 years, it will keep on paying that $6,000 a month. Unlimited for life for both of you. You don't have to add this rider, but it's so cheap. And I would say 99% of the families we work with who we design this type of plan, they use that rider because you get so much more protection. I settled back in my chair. What questions do you have for me? Jackie replied quickly, well, obviously this blew our expectations, for sure. We will definitely need to think about it and we'll have some questions. Unfortunately, I need to take my mother to the doctor, so we need to get going. Do you have any time later this afternoon to meet? I checked my calendar. I've got an hour between 2 and 3. You're welcome to swing back by. 1:57 p.m., my desk phone rang again. Bill and Jackie are here. They walked in and pulled out a notepad full of scribbles. Good, you all talked about it. Jackie started in, yes, I think we've narrowed it down to 4 questions. Number 1, who offers and backs these types of plans? Number 2, you mentioned the enhancement rider for lifetime unlimited coverage has a cost. Does that cost increase? Number 3, is $6,000 really enough coverage? And number 4, how are you paid? Great questions, I said. Let me address them one by one. Number 1, most of these plans are offered by large insurance or financial companies. There's a variety of options, and it depends on your health and goals for which companies we use to design your individual plan. Now, if you have concerns about the strength of insurance companies, let me address that. Insurance companies have more money than the banks and Wall Street combined. And the key thing is, insurance companies aren't highly leveraged. In fact, they have to reserve $1 of assets for every dollar of liability. They aren't like banks, which are very highly leveraged. You know, a bank takes in $1 and they keep maybe 8 cents, 10 cents, and they loan the rest out. Insurance companies can't do that. In fact, insurance companies probably are generally the last thing to go down next to the government. Okay? Bill ventured, well, what about AIG in 2008? Didn't they have a lot of problems? I smiled. Yes. Everyone thinks AIG stands for American Insurance Group. It actually stands for American International Group. And that whole fiasco, it was actually only the insurance division that was solvent and had any value. It was the rest of the company that was getting into mortgage-backed securities and all that stuff that was struggling. I could tell the engineer in Bill was pondering what I was saying. I offered one more thought. But really the question I always ask is, when is the last time you heard of a little old lady not getting her $500,000 life insurance policy? Bill replied, I guess never. Do you know why? I asked. He stammered, no. I continued, well, obviously, because if the insurance companies ceased to pay claims, the whole industry would cease to exist. If all of a sudden they started not paying out the benefits they promise, we'd all stop trusting them and simply cancel our insurance. The industry would end overnight. So naturally, what happens is if a company comes on hard times, they're always simply bought out by a bigger insurance company who makes good on all the claims. I can go deeper into that if you'd like. No, that's okay. That makes sense, Bill said as he relaxed back into his chair. Well, let's move on to your second question. Does the enhancement rider that makes the coverage lifetime unlimited for both of you, does that cost ever increase? And the answer is no. It's guaranteed to stay flat for the life of the policy. It's one of the reasons we like it. You'll never have to worry about that cost increasing, forcing you to drop the policy. No, instead, you know the coverage will be there when you need it. Well, that's wonderful, they replied. How about if $6,000 is enough coverage? Jackie asked. Well, that depends on a host of variables. It's different for everyone. But based upon your budget and money, I think it's a great place to start. If you think about it, we're never trying to solve the whole problem. You're going to have Social Security, you're going to have investment income, etc. So you have to take all that into account as well. Yes, there will be inflation. So if you want, we can always explore adding more benefit now, or we can take a look at it again 5 to 10 years down the road and if you think there's a need. The important part is to get some type of coverage into place while you're still fairly young and healthy in order to get the best rates and in order to protect yourself should your health change and all of a sudden you couldn't qualify. They both nodded. Yeah, I never thought about how we'd have other income as well. Let's stick with the $6,000 for now. And so your last question, I continued, was how do I get paid? Also a good question. My fee for helping you with this is $6,700 payable at the end of this meeting should you decide to move forward. I let the silence hang for a couple of seconds, and Bill and Jackie visibly shuddered. Then I let a grin spread across my face. Just kidding, just kidding. The insurance industry is set up to pay a commission to me. It's very simple, and it's included in the cost of doing business for the insurance company. Now, commission's usually a bad word, but it's just how the industry is set up. Now, the good thing for you is that I'm a broker for about 40 different insurance companies. I'm not a W-2 employee for any particular company. So in building your plan, I get to go out and I find the best company or the best maybe couple companies and build the best plan to match your needs. And that company pays me. I definitely don't work for free, but I am free to you. I could tell Bill liked that. How do we get started? They asked. Well, first you have to apply. They're going to look over your finances and your health. And they're actually even going to check your cognitive ability. They're going to do a phone call with you and try to trip you up. But if you apply and if you get approved, obviously it will be one of the best financial decisions you'll ever make for protecting your future. And the rest, as they say, is history. They applied, they got approved, and every night, Bill and Jackie sleep well, knowing that if a long-term care catastrophe ever happens, they'll be fine. They can grow old together and make memories and enjoy their retirement, travel the world if they want, live a long and happy life. And if something happens, their sons will be fine, their healthcare will be fine, their nest egg will be fine. Now that's a story with a happy ending. And we do this for families all the time, and we can do this for you. So what I'd like to offer you today is a long-term care strategy session. This obviously isn't a 60-minute high-pressure sales call. This call will last anywhere from 10, 15, 30 minutes, and I'll ask you some easy questions, learn a little bit about your health situation and your financial situation. Okay, now I'm based out of Kansas City. If you're in Kansas City, we'd love to have you come to our office and meet you face to face. But if you aren't in Kansas City, we can simply talk over the phone to get started. And during this call, we'll actually be able to design a plan and see what options you might have. By the end of the call, you're going to know if whether or not securing coverage even makes sense for you. You'll know the top 1 to 3 strategies that are available for you. We'll walk through the solutions and you'll understand exactly what your options are, what it costs, and what you can do to wisely protect your family, healthcare, and assets from a long-term care catastrophe. So here's the deal. I'm a financial planner. I manage assets. I do a lot of things. And I usually charge about $200 for a financial planning consultation depending on how long it takes. However, if you go to our website, I've cut the long-term care strategy session cost to a flat $100. But as a special offer, for those of you who put in the time and watch this video to the very end, like you have, I open up 10 slots and 10 slots every month to do completely free, no cost long-term care strategy sessions. I do this because I feel like you've already come a long ways and you've learned a lot. So when we do meet or talk for a strategy session, you're already educated. And yes, we'll have to review, talk about your specific situation, but we're not starting from ground zero. And if you end up on a call or in my office after watching this, I know that means you're serious about doing something. You're not wasting my time or yours. I also know if you see something that you like and we design a plan, you get approved for it, and you fund it, I'll get paid on the back end by the insurance company or the financial company who backs the plan that we design. So no one's working for free here. Okay, so to reiterate, because I stay very busy with a lot of other things, I'm only able to offer 10 no-cost long-term care strategy sessions every month. Once the 10 slots are used up, you're going to have to wait until next month. So take advantage of this offer, be amongst the first 10, make sure you schedule your strategy session sooner than later. So here's what you need to do right now to take advantage of the offer. On the page, you should see a button that allows you to schedule a free strategy session. Go ahead, click on the button right now, and you'll be able to schedule a call or a face-to-face meeting with us to go over your situation and learn how to design the very best plan, the very best solution for you. You'll be able to see our calendar and pick out a time that is convenient for you. Remember, these appointments will be done either virtually in Kansas City in my office or over the phone. Just find a spare half hour in your day. Okay, and let's talk about your future. So go ahead, quickly click the link, book your strategy session. Remember, there are only 10 available each month, and my schedule tends to fill up fairly quickly. Okay, so go ahead, book a strategy session, and I look forward to talking with you.